and I'm the host for today's session. So this afternoon, we are privileged to have Wei Cheng and Wang Po, junior analysts from Morris Grayson, a management consultancy firm. They will be our speakers for this webinar. They will be sharing with us about the fundamentals of technical analysis in the foreign exchange market, laying the foundations of the subject matter, and clarifying doubts or queries some of you may have about this topic. This session will be kickstarted by the sharing of our speakers, followed by a question and answer segment. The link for your questions will be provided in the chat function, as well as at the end of the presentation. So if you guys have any questions along the way, do fill up the form and send them in. I will then raise the questions up to the speakers once this presentation is over. So without further ado, let us welcome Wei Cheng and Wang Po to begin today's session.
Okay, thank you, Alistair. I will now start with today's webinar, Intro to Technical Analysis. Today's agenda is to first start with the introduction, followed by charts and orders, risk management, indicators that are commonly used in trading, chart patterns, and lastly, our conclusion. So there are actually different methods to analyze a currency pair. It can be done either through technical analysis or fundamental analysis. For today's webinar, we will focus mainly on the technical aspect. Technical analysis makes use of the charts and indicators to identify market trends and price movement. There are two types of market movement, the bull market and the bear market. A bull market signifies a sustained increase in price, while a bear market signifies a continuous decrease in price. In the Forex market, the price of the currency pair can move up or down. To profit from these movements, we can either buy or sell the pairs. When we buy, we are expecting the price to rise, and our profit will be the difference between our entry and exit price. For example, we purchase an apple at $1 and sell it at $2. Therefore, we earn the profit of $1, which is the difference between our purchase and sell price. And while when we sell the currency pair, we'll profit if the price starts to go down. There are three main different types of trends in the market. The first is the uptrend. In an uptrend, the price of the currency pair gets higher and higher. The second form of trend is consolidation, where the price moves in a range. The last type of trend is the downtrend. In the downtrend, the price of the currency pair gets lower and lower. In technical analysis, we assume the market has priced in past incidents, which means what has happened should not affect the price of our investment further. We also assume the market moves in trend. When the price of a Forex pair goes higher and higher, we expect the trend will continue for some time. But last but not least, in technical analysis, we believe history tends to repeat itself. This means we assume the price movement and patterns often repeat itself, making it possible for us to trade and profit from patterns. This is an example of how the market moves in trend. The chart shows a period of 1.5 years. The market moves up and down within this period of time, but generally, it shows a very obvious downtrend and has lasted for a very long period of time. Market often repeats itself. As shown in this example, the market has been moving in a range. The price cannot break out from the top and the bottom red line. The price movement repeats itself between these two red lines, which provides us some entry signal. We can sell at the top red line and buy it at the bottom of the red line. Moving on to the charts and orders. There are two very commonly used charts by traders, bar chart and candle chart. This is how a bar actually looks like. For the bar chart, the green bar means the price has moved upwards from its initial opening. This bar opens at a lower price than its close, representing an increase of price for the Forex pair. For example, it opened at $1 and closes at $2. The low and high in the stick is the lowest and highest price, which was achieved in the time frame of the candlestick. For a 30-minute time frame, one candlestick represents movement for a duration of 30 minutes. For bearish bar, it opens at a higher price than its close. This represents a drop in price during the time frame of the candlestick. For example, the bar opens at $2 and closes at $1. So this is a candlestick chart. It is also the most commonly used form of chart by the traders. Similar to the bar chart, the green candlestick means a bullish candlestick, while a red candlestick means a bearish candlestick. For the bullish candlestick, the open price is lower than the closing price. The two thin lines at the end of the candlestick are the high and low point of the candlestick. For the red candlestick, also known as the bearish candlestick, the price opens above the candle's close. There are 5 common forms of entry order: market order, buy stop order, sell stop order, buy limit order, and lastly, the sell limit order. For market order, we buy or sell the currency pair at the current market price. In the given example, the selling price for the Forex pair will be $17.41, while the buy price is $17.46 when we round it up to 2 decimal places. For the buy stop order, you need to set a buy entry above the current market price. So when the price of the currency pair increases, it will trigger your order. One way to use it is to trade breakout trades. For example, a Forex pair is facing a very strong resistance at $10 benchmark. We can place a buy stop order at 10.20, so that if the Forex pair breaks out from its resistance, our order will be triggered at the market price at that point of time. For the buy limit order, we have to place it below the current market price. When the price of the Forex pair falls to our buy limit order, our trade will execute at the market price. On the way to utilize it is to place the buy limit order at an area near the resistance. For example, the Forex pair is now currently trading at $10.20, and a strong resistance was formed at $10. We believe the price will hit the resistance and bounce off. Therefore, we can place a buy limit order at $10. When the price hit 10, our trade will trigger at the market price. Sell order is the reverse of buy order. For the sell stop order, we have to place it below the current market price. As mentioned, when we sell a Forex pair, we can profit if the pair actually drops. One example of using a sell stop order is to place it below the support. In the case given in our slide, the support level is at 10.20 cents. Therefore, we will put our order at $10, slightly below the support range. When the price breaks from the support, it will trigger our request at the market price. On the other hand, the sell limit order has to be placed above the current market price. We use it when we predict the price will actually go up in the future, hit our entry, and then come down. In the example shown, we place our sell limit order at $10.20, near the strong resistance and above the current market price. We will profit if the price of the Forex pair actually goes up, hit our entry point, and come down. Coming to the risk management part, risk management actually plays a crucial role in trading. It can help us to cut our losses in losing trades and manage our emotions so that we won't let our emotions take control of us and make silly mistakes. Lastly, with proper risk management, we can achieve a more consistent result in our trades. So how can risk management help to achieve all the above that I just mentioned? Firstly, most people hate defeat and accept losses. So when some of our trades goes against our plan, it's tough for some traders, especially the beginners, to close the trade at a loss. This psychological idea can turn a small loss into a very big loss if you do not face the reality. To prevent this from happening, we need a proper risk management and plan. Put our emotions aside and follow strictly to it. A simple risk management plan can significantly reduce unnecessary losses. Secondly, a lot of traders, especially beginners, can be emotionally affected as they start to lose money. But our mind is not clear or it gets controlled by our emotions, we stand a chance to make silly trades and make unnecessary risks in our trade. However, with proper risk management, we can actually control the amount of money we can possibly lose. We can set the amount of possible loss in an acceptable region. This can lower the probability of being emotionally affected. Lastly, risk management is crucial in attaining a consistent result in our trades. Knowing how much to lose and gain in every single trade, our final result will be relatively stable. Next, I will show you some ways to manage risk, followed by some examples. So there are 4 basic risk management techniques that we can adopt. Firstly, we should determine our stop loss and take profit points before we decide to enter any kind of trade. After knowing our stop loss and take profit point, we have to decide the amount of money to risk for each trade. To ensure a consistent result, we should risk the same percentage of our capital for every single trade. At the same time, we have to ensure the trade we take potential to achieve more than 1-to-1 risk-reward ratio. This means that when we risk $100, we stand a chance to win at least $100 from the trade. Knowing the risk per trade is not enough. For traders that focus on technical analysis, we should also choose a percentage of risk per day. When we lose more than the planned percentage of risk for that day, we should stop trading for the day. That's the end of the day. This risk management strategy is to avoid days that have high volatility or the price movement of the market is actually against our strategy. At the same time, this strategy also prevents us from overtrading when we are mentally exhausted. I've mentioned the importance of deciding a fixed risk on every single trade. So to show the effect of our risk management, we have to stay away from trading currency pairs with a strong correlation. Those currency pairs have similar price movements, which means if we are risking 1% per trade and we are taking on 5 trades with strong correlation, it's the same as taking on 5% per trade. For the next few slides, I will show you some example on the importance of risk management. So as you can see, when we trade without a stop loss, we incur the possibility of losing a lot of money in a single trade. In the first chart, we can observe a very, very strong uptrend at the start, but the trend eventually reversed. And if we decide to enter the market at the green circle area, as I draw on the slide, without a stop loss, we are open to suffer the amount of loss as shown by the red arrow. Enter a trade without a profit target point can also turn a profitable trade into a loss trade. In the second chart, the trade is profitable if we sell at the red circle area and close it before the trend starts to reverse. However, if we do not have a take profit target, our profit will eventually turn into a loss as the trend starts to reverse. So if we do not have a fixed percentage of risk per trade, we will not be able to profit consistently. In the example shown, we will lose about 3% of our capital that we risk in the trade if we sell at the bottom of the downtrend. Afterward, we found another opportunity and sell it again. But this time, we risk only 1% of our capital. So we win the second trade, but we lose the first trade. For the first trade, we lose 3% of our capital, and the second trade, we only win 1% of our capital. So the overall result is a loss of 2%. So it shows the importance to have a fixed percentage of risk per trade, so to prevent a situation like this. Sometimes there are news and events which can cause high volatility in the market. There are also days where the market goes against our strategy. In a day like this, we can lose majority of our trades. Therefore, by setting a fixed amount of risk per day, we can control our losses in those kinds of situations. Some pairs have a very strong correlation. For example, the GBP-JPY and GBP-USD pair. Both of the pairs are having similar price movements. Therefore, if we invest in both of the pair, we can either win both or lose both of the trade. This contradicts the fixed risk per trade management plan. In the plan, we set a fixed percentage of risk, for example, 1%, right? However, if we buy pairs with strong correlation, it is similar to risk 2% in one trade, since both of them are having the same price movement. To prevent ourselves from making this mistake, we should buy pairs with different currency mix. Coming to the Forex indicators, today we will be going through 3 different types of indicators: the trend, momentum, and volatility types. Moving average is very commonly used by traders to show trends. There are many forms of moving average. 2 of the most used are simple moving average and exponential moving average. A simple moving average is less sensitive compared to sensitive to a change in price compared to an exponential moving average. The example shown utilizes a moving average as buying and selling points. When the 10 days simple moving average crosses the 20 days simple moving average, and both of them are showing positive gradient, it indicates an uptrend. The point where the 2 moving average crosses and also used by many traders as entry point. The blue double set arrow on the chart actually shows the profits earned by using a simple moving average as entry and exit signal. These indicators perform better in a strong trend market. The relative strength index is a tool to measure overbought and oversold in the market. The region above 70 actually indicates overbought, while areas below 30 means oversold. In this example, when the relative strength index hits below 30, the oversold zone, we should deter ourselves from selling and gravitate towards buying. When RSI hits above 70, the overbought territory, we should lean towards selling instead of buying. The last indicator is the average true range. It can be used to measure the volatility of the market. The default setting for this indicator is actually 14 days. It is the most commonly used time frame for traders. So average true range is a very crucial indicator for traders, as it helps them to decide their stop loss and volatility and find out the volatility of the market. In the example shown, in the period of consolidation, the average true range is at about 20 pips range, while after the Forex pair break out from the consolidation, the average true range has increased to about 50 pips per candlestick. If we do not use the average true range, we won't be able to determine the correct stop loss at different periods of time. Next. Technical trading is a statistic game. To make it easier to understand, I will use casino as the example. Casino can win lots of money from gambling. They can achieve it as they possess an edge over the normal players in the game. The usual card games, like blackjack and baccarat, can generate millions of dollars to the casino, despite a mere 0.5 to 2% edge it offers to the casino. In technical trading, we can treat the Forex market as the casino, and we are the players. So in a normal situation, a trade can either go up or go down, right? Therefore, we have a 50% chance of winning. Since we need to pay commissions to the broker to enter our trades, we are eventually at a disadvantage in the game. However, if you make use of indicators and strategies in our trades, we can achieve more than 50% win rate. And at the same time, we can also exit our trade if it's not in our favor. This can actually help us to reduce and cut our losses. So with sufficient learning and testing, these two factors will put us at an advantage in the market. We become the banker in the casino, holding an advantage and stand a chance to profit from it. Statistically, we will profit from the market if our strategy has a higher than 50% win rate, our ability to achieve a good risk to reward ratio. The freedom to enter and exit the market gives us an edge in terms of risk to reward. At the same time, we can always look for trades that give us the potential to earn more than what we plan to risk. For example, we can find trades that give us the potential to earn $200 by risking only $100. So through learning and testing, if we can create a strategy that generates a 50% win rate, the risk to reward ratio is about 1 to 1.5. We can easily earn 25% of our capital within 100 trades by risking 1% of our capital per trade. Thank you. I will now pass the time to Wei Cheng.
Okay, thank you, Wangpo. So after talking about indicators, let us move on to the chart patterns. So in the Forex exchange market, there are mainly three common market conditions. As you can see here, uptrend, consolidation, but last but not least, the downtrend market. So for uptrend market, it signifies through characteristics such as higher highs and higher lows. So one can simply identify these characteristics on their chart and attempt to connect these points together and get a clearer picture of the market condition. So here, for instance, in our case here, two trend lines are drawn to connect these higher highs and higher lower lows and higher lows together, hence giving us an essential information on what is the current market condition. While for ranging market, it can be seen by the price movement moving up and down through a constant tunnel-like structure, as you can see here. And lastly, for the downtrend, it is essentially an opposite of the uptrend, where you get a lower highs and lower lows rather than usual higher highs and higher lows. So similar to an uptrend structure, you connect these highs and lows together using a trend line, and you get a very obvious pattern that shows you the current market condition, which is the downtrend. So after knowing how to identify market conditions, one also needs to understand how these chart patterns are formed in the market, right? So for instance, in a typical candlestick chart, it's made out of numerous candlesticks that represent the price movement for a set of duration. So some of you might have known that when you open the trading platform, right, you will see many different time frames. For instance, like weekly, 4 hour, 1 hour, or even lower ones like 5 minute or even on 30-second time frame. So what exactly do those mean? So here, for example, you can see your daily time frame. Each candlestick represents the price movement of a Forex pair for duration of a day. And here I box out a candle on a daily time frame to show you guys the difference in the number of candlesticks as we transit down to lower time frames. So here in your 4-hour time frame, there are more candlesticks being observed, and this is being recorded at a lower time frame. So you can see when we got to the 1-hour time frame, there are many candlesticks in the same rectangular box relative to a higher time frame like the daily ones. Next. So as mentioned earlier, lower time frames, you will see increasing number of candlesticks for the same duration of the price movement. And this is the same as we observe market condition patterns. So here we have an example of a downtrend pattern, lower highs and lower lows. So for your own trading, as you will draw the trend line for a specific chart pattern you have identified depending on the market conditions, and you really need to be cautious about the time frames that you are using. So here we have, for instance, in the 1-hour time frame, despite it being an overall downtrend, if one do not look at a higher time frame before going down to 1 hour, he or she might think that the market is in an uptrend or there's a reversal going on, or even like not being able to spot any potential chart patterns here. So it's very essential to look at go from higher time frame then lower time frame. So overall, I think the key takeaway for this slide is really to check higher time frame before moving down to lower ones. As you go higher, there's lesser noise in the market. So by noise in the market, I'm referring to, like in the case of 1-hour chart, you see there's a lot of price movements and it's giving you unclear information about the market condition compared to a higher time frame like the daily ones, which give you a cleaner chart and of course a clearer view on the overall market condition. So I'm sure this question will have been on mind by now. So what time frame do I use, right? So a time frame used really depends on one's trading horizon. So here, I think the most 3 commonly known type of traders is scalper, day trader, and as well as your swing trader. So for the scalper, right, they profit from small price changes. So the commonly used time frame for them are 30-minute, 50-minute, or even lower ones like 5 minute as shown here. While for the day trader, they profit from a price change within the day, meaning that they do not hold overnight positions. So they buy and sell during the day, and commonly used time frames are 4 hour to look for the broader trend in the market while utilizing either 60-minute or 30-minute for entry in the lower time frame. Or some of them might use 4 hour to check for broader trends and use only 60-minute for the confirmation of trends and then 30-minute for the entry. And lastly, for swing trader, they profit from price changes over a few weeks or even a few days. Commonly used time frames as see here are daily and 4 hour. So let us go through an example of a trade execution by a swing trader, essentially to give you a clearer picture on how is it like to trade in the Forex market. So here, a typical swing trader will first go to the daily time frame to get a sense of what is the broader market condition. So here there's a lower high and lower low, which give us a very nice downtrend pattern when we draw our trend lines connecting these points together. Moving down to the 4-hour time frame, however, we observe a mini uptrend within a downtrend. So does that mean that the trend is up? Of course not. As mentioned earlier, higher time frame usually dictates the overall trend in the market. Hence, if one did not check the daily time frame, but instead went to the 4-hour charts, he or she might think that the reversal is about to happen or thinking that the uptrend will continue. However, that is not the case. So here, the price action has rejected nicely from the trend line and back down, following the broader market consensus on the daily time frame, which is the downtrend. So a short position here is placed, which I think one more mentioned earlier, different orders. So one of it, which is sell limit order, where you can sort of sell at that specific level. So, and this order was triggered as the price approaches the trendline resistance as shown here, and also the stop loss is set at the previous high of the level 111.008, while the take profit level is set according to the risk to reward ratio of 1:3, meaning that I am risking $1 to earn that $3 profit. For this example, the price went back down all the way to the bottom trend line support level. If you want to be more aggressive in your trading, of course, you can aim for even higher risk to reward ratio, maybe 1:5 or even 1:6 to lock in a higher profit for yourself. However, in life, nothing is 100% or guaranteed as witnessed by the event of the negative oil price futures, where many brokers didn't even account that in their risk models. So I think it's always better to sort of be conservative, and here, so we only aim for a lower profit target rather than all the way down to the trend line. So next, let us talk about the reversal pattern, which is another very commonly used pattern in the Forex market. So this pattern usually signals us whenever there's a potential transition or change in a particular trend in the market. So for transition from a downtrend to an uptrend, you will get a double bottom, while on the other hand, from a transition from an uptrend to a downtrend, you'll get a double top. So otherly common patterns are triple bottom or triple top, where price action respected a level 3 times before there is a transition of a trend either to the upside or the downside. So other patterns also, there's like head and shoulders are also quite common. So the reason why is it called head and shoulder, you might wonder, is because the highest point looks like a head, while the two lower end looks like a shoulder. Yeah. Now let us take a look a very common used tool. I'm sure many of you all have heard before, like when you all start learning trading. So it's the support resistance. So one of the common ways that people determine the strength is through the number of touch points of the support resistance. So comparing to a 3 touch point versus a 2 touch point resistance or support setup, the one with a higher number of touch points signifies a stronger level of support or resistance. So another way people determine the strength of a specific support resistance is through really drawing it on the line chart. So this is done through identifying sharp turning points on the chart, on the line chart, and they think that is another indication of a very strong potential strong support and resistance level. So these are comparison of a line chart and a candlestick chart. So the main difference between them is that for a line chart, it only shows the closing price of each candle, while not the whole like price movement of a specific time frame. So for the candlestick chart, as you can see, it shows both the closing price as well as the highest and lowest price that a Forex pair moved in a particular time frame. As you see, it's circled here. In the candlestick chart, there's wedges which shows like what is the highest price level that was reached within a specific time frame. In the case here is for USD JPY pair. Next. So what does this information tell you, right? So what if I identify a very strong support resistance level? So here we have a 3 touch point level, as you can see, using this as an example. So once we have observed that the price broke that particular support or resistance level, and if the price went back up to that particular level, there's a very high possibility that it will respect the level, since it's a very sort of relatively strong level, hence giving you a very nice support term resistance or resistance term support setup. So this is a very common setup that you can use when you are starting to trade or doing your demo account to get a sense of the market. Yeah. So of course, with so much strategies are being taught, like patterns, indicators, regardless of what, it's very important to emphasize this, that you need to really have a very your own set of risk management rules in place. So I think one of which is like here, so we have a 30-minute time frame for Euro USD pair, as and here you can see there's a very obvious support level being drawn around, I think there's 4 to 5 touch points for this level, and you can see that once the price broke this significant support level, it sort of did a few hours of consolidation before going back up to the previous support level. And as mentioned earlier, for this example, this is a very typical setup of support term resistance, whereby the price respected the previous support level, triggering my sell limit order, as you can see here, before continuing to the downside. So for the trade execution pertaining to the risk management part, we have a very good risk to reward ratio of 1:6, where our stop loss is set at the previous high at 1.094888. and a take profit level at 1.07818. So this simply means that I am risking $1 to earn that $6 profit. Of course, this setup, many of you can see that it's cherry picked from the charts, and in real life, this kind of risk to reward ratio, it's really depends on your personal strategies that you have developed for yourself, with setting specific entry and exit conditions, as well as the risk you are willing to take. So in the market, the usual advisable risk to reward ratio is minimally to have at least 1:2. So meaning that you risk $1 to earn that $2 profit. However, there are also other people in the market, having a risk to reward ratio of 1:1 or even 1:0.5. Like you're risking $1 to earn that $0.5 profit. So to me, I think it's very risky personally, since I'm quite conservative. However, I think if you are very confident in your trading setup or strategies, like if it has a very high win rate from your backtesting, then by all means you can have a sort of like riskier risk to reward ratio and take more risk. If you have higher win rate, essentially you can still win in the long run despite not having a very good risk to reward ratio. So what is the point of using indicators in your broker, right? If everyone has the same trading tools, right? So for me, I think I want to differentiate myself if it's me and look for other indicators or uncommon ones, trading tools out there in the market. So some of the platforms that are quite common and also like provide an extensive stash of indicator files that you can download and explore yourself. So you have your forums and communities like MQL4 as well as MQL5 and also the Forex Factory. So for brokers, I'm sure you have heard Wanda from your friends. I think it's quite popular in Singapore, and I think it's very well known also. And I think another less common ones are, I think it's not bad, is IC Markets. And moving on to the trading platforms, that are most common ones are MetaTrader 4, MetaTrader 5, as well as TradingView. So if you download indicators from sort of like this platform like MQL4, right, the coding language is different. So files from MQL4 only can be used in MetaTrader 4, but not in MetaTrader 5. And the same goes for MetaTrader 5. So these are something that you need to take note of. And if you're exploring like in forums like Forex Factory, so some indicator files are coded in Python or other coding language. So you need to take note and convert like maybe the Python language to MQL4 language. Then before putting it into your MetaTrader 4, then you can use it to backtest. So these are some of the things that you need to take note of. And lastly, for trading ideas and setup, I think you can also head on to TradingView. I think it's a very good source. So essentially, it is a community of traders where they publish their trading ideas and both technical and fundamental daily on the platform. So these are some of the sources that we know that you can explore yourself. So essentially, the overview is that you can use our chart pattern or indicators to essentially to check what is the broader market trend, or you can use it together and overall and build your strategies based on your own rules and trading setup. With that in place, you of course back testing is also required, right? So if you have found a setup or indicators you are excited or confident about, before putting in your overall trading strategy, you really need to back test the using historical data to ensure that it is good, and before like trading live account. Or you can even do a forward test using a demo account. Yeah. And also you also need to set conditions for yourself, as very important. You don't want to include the emotional part of you in your trading strategies. So for example, like some of the conditions, for example, like when do I enter or exit the market? If my indicator shows like X, what do I do? Or do I wait for confirmation for another indicator that I enter? So these are some of the things that you need to ask yourself and set for yourself before sort of like trading live, and not allowing your emotions to get in the way. And of course, conditions differs for individuals. Different people have different trading styles or trading horizons, and each of us also have different risk appetite, which will differ in our sort of like risk to reward ratio and risk management. So for risk management, as mentioned earlier, usually minimum advisable is 1:2. You are risking $1 to earn that $2 profit. However, if you are confident and have a very high win rate, you can go lower, as mentioned earlier. Can go lower to 1:1 or even 1:0.5. Yeah. But generally, I think if you are a swing trader, means that you tend to hold longer positions for days or even weeks. I would think that you need a minimum of 1:2 or higher risk to reward ratio, like 1:4 or 5. Cause as you hold your position, you also need to pay the swaps to your broker on top of your commission, right? So, well, for scalper, I think the risk to reward ratio can be lower since they profit from small changes in price level. So I think 1:1 will be quite common in my opinion. Yeah. So lastly, really, I think like based on my experience, it's really different when you are trading a demo and a live account. So when you put your own money inside, really different as you include the emotional part of you. So overall, I think that you really need to remove the emotional part and stick to your trading rules while you set them. And whether you win or lose money, you really need to still follow the same set of rules and not get confident or risk more money to get that higher profit. So that's all for me. I hope we have value add to your trading education, and back to you, Alessia.
All right, so thank you both Wei Cheng and Wang Po for the sharing. And we will now be moving on to the question and answer segment for today's webinar. So thank you for all the questions that were submitted onto our Google Forms. If you still have questions, feel free to access the question and answer form via the link or by scanning the QR code as shown in the slide above. We'll try our best, but should we face time constraints, we may not be able to address all the questions. So let us begin with our question and answer segment. Our first question is from Daryl, and he asked, in your opinion, what do you think is the best risk to reward ratio?
Okay, Daryl, thank you for your question. So, actually, right, there is no best ratio as the choice is actually personal and it really depends on the strategy that you adopt in your trading. But in general, people use 1:2 risk to reward ratio as it actually maximizes your profit on winning trades and limit losses when a trade actually move against your strategy. So when you use, for example, if you use 1:2 risk to reward ratio, right, we can actually break even with only a 33% win rate. Then some traders, right, they can trade with a very low risk to reward ratio. For example, risk to reward ratio less than 1, but they are still profitable because their strategy can achieve like 70%, 80%, or even 90% win rate. Therefore, it really depends on your strategy. So in technical trading, right, a trader is able to profit if the chance of them winning multiply the amount of risk, the amount of reward they earn through trading. If it's higher than the probability of winning times the risk, then you can profit in the long run. So because risk to reward ratio is actually only part of the equation, so we shouldn't just focus on that. We need to find the best ratio based on our strategy rather than focusing purely on that. So you have to know that when you are trying to aim for higher risk to reward ratio, right, your win rate is likely to drop because risk to reward ratio and win rate, they are inversely proportional. Yeah. So the best risk to reward ratio actually depends on your strategy. You need to test and do some experiment on that to find the best optimum. Yeah.
All right. Thank you, Wang Po. Our second question is from Peng Ni. His question is, so in light of the coronavirus situation as well as the nationwide lockdown all over the world, what do you think is the outlook of the US dollar moving forward?
Okay, so I will take a question. So essentially, the outlook for US dollar really depends on the demand supply. So the global demand, so appreciation, and so the appreciation or depreciation of USD going forward depends on global supply and demand. So if you demand people demand more for USD, the currency will appreciate. So if like decreased demand will depreciate or increased supply of USD will depreciate. So the appreciation and depreciation of the USD outlook really depends whether if there is a second wave of inflation and how fast like the global trade will resume. So in the first scenario, if the global trade is and there isn't a second wave infection, this will really increase the circulation of USD, which is a global reserve currency. As you can see, the Federal Reserve have been printing a lot of this. And so there is supply across the globe. However, there just isn't much circulation. So when global trade is, the supply will be more obvious where there's circulation. So this will increase the supply of USD. This will lead to depreciation and hence global inflation. As you know, countries that trade with US need to readjust their exchange rate and sort of like match. And this is very sort of like damaging to countries that are really dependent on export-driven growth. Yeah. And the second scenario is that if there's a second wave of infection and the global trade sort of didn't ease, there might be an appreciation of USD where there will be more panic and investor will flock to more safe haven assets like US Treasury bonds, which you need USD to buy, right? So essentially you increase the demand for USD and this will appreciate. And another demand driven factor will be, as seen recently, the shortage of USD across the globe, where the Fed really need to sort of provide Forex swap lines to different central banks across the globe to provide the USD for liquidity issues. So one of the main reasons is that companies in emerging markets that have debt denominated in USD need USD to pay this debt, hence the shortage. So both of these factors will really drive and resulted in USD to appreciate in the future. So personally, of course, I hope it will be the first scenario, first case where everything becomes better. Yeah, thank you.
All right, thank you for your answer. The next question by Benjamin. He asks, in the event of a flash crash, will one stop loss order be triggered?
Okay, I will answer this question. So firstly, thank you for the question. So I will explain what a flash crash is at first, in case some of the audience does not know this term. Yeah. So a flash crash, right, is actually a very significant or dramatic decline in the price of your Forex or any kind of investment. So it is usually caused by rapid sell-off of the investment or stocks or Forex pair, whatever kind of investment you do. So when the price of the security, right, actually experience a very high volatility, it may trigger some of the traders' stop loss. So this causes the price to drop further and eventually creates a domino effect. And this is how, as more and more stop losses are being triggered in the process, it actually causes a flash crash. So a stop loss order, right, is first designed to protect traders. However, it only works, right, if there is a buyer or seller in the market. So when we buy a currency pair, there must be buyers in the market that sell the pair to us, right? So to make it easier to understand, I will illustrate it with some example, a simple example. So it's like when we want to buy an apple at $1, there has to be a seller that is willing to sell this apple to us at $1. If there isn't a seller, then we will have to pay more money, right, to attract more sellers to sell to us. So we may be willing to pay like $1.10, $1.20, depends on whether the seller wants to sell to us or not. So during flash crash, right, a lot of traders' stop loss are being triggered. So suddenly there are too many sellers in the market, while there is not enough buyers. So the imbalance between the demand and supply has caused the price to drop and drop. Since the price that when the price hit our stop loss, right, well, our stop loss will be triggered at the market price. But as the price are falling too rapidly, too fast, the stop loss trades couldn't be executed at the correct price. Yeah. So in most of the case, right, during the flash crash, our stop loss price is like when they execute is like far below the value that we actually set before. Yeah. So during a market crash, you can expect your stop loss to trigger at a very, very, very low price compared to what you set. Yeah.
All right. Thank you for your answer, Wang Po. Our next question, there's several people who has asked this, so I will group them together. It's from Brandon and Wes. So they mentioned that in your slide, you mentioned about backtesting. So how are we supposed to go about doing that? And if you may further input, what are the accessible terminals or channels we can do so?
Okay, so I'll take a question. Okay, so for backtesting, there's a few ways you can do. So for MetaTrader 4 and MetaTrader 5, they have this like inbuilt backtesting software. So that's one of the things that you can use. Another way is that you can do if you are very proficient in code, you can sort of do your own backtesting, right? You can code, or you can even code your own like indicators and backtest yourself. And another one I think is the most common if you are not very tech savvy, or like you are just confused. So I think it will be best to do a manual backtesting. So for example, you are using moving average. So if moving average then cross 12, like cross below 12, then you sell. So something like that. So you can maybe like backtest maybe like 50 times, right? Central limit theorem tell us that 30 is enough, right, to build a normal distribution curve. Okay, so yeah, so that's some of the ways that you can do it. And also online, I think there are also some like Excel models that you can find. Of course, you need to do your own research where people have their own backtesting models that you can use. Yeah.
Okay. Thank you, Wei Cheng. Moving on to our next question. It is asked by both Charlie and Grace. And so they ask so if I want to begin trading online, so where do I begin? Or do you have any tips or resources for a beginner who is looking to learn more about trading?
Okay, I think for that, one of the best resource that I have sort of first come in contact with is Baby Pips. So it's on Onda, you can go and check it out. It's really simple. They simplify all the sort of like the jargons to layman terms. So that's one of the resource that you can look into. Another one I think is good is YouTube. Really, you just search what you want to know. For example, you open the trading platform, then you saw some functions that you don't know, you just go YouTube and search how to use this function XYZ. So it's really a process of really like you go and do it, and then you find out what you don't know at a spot, right? So I think that will be a very good start if you want to start trading. Yeah.
Okay, thank you. Moving on to our next question. So, Wei Cheng, with regards to the use of indicators that you mentioned, shouldn't we be using indicators that are popular as it gets more accurate with more people using it?
Okay, I think first we need to understand like who is trading in the forex market, right? If for example you and me trade, right, we are known as the what, retail traders. However, there are also professional traders. There's different funds out there that are trading, and also banks are also trading, fulfilling their clients' quote. So all of this, you need to know that banks, all the big players move the market, so you need to follow the big players. And now like most of the trading done in banks are high frequency trading, if you don't know. So of course, so you need to find uncommon indicators to sort of like get like away from the radar, right? So of course, what is provided by the broker, of course, it's not, there's a conflict of interest. Why? Because who provide the loans to the brokers is the banks, right? So the brokers will sort of like, sell your data to the banks, and then they will know, what indicators are you are using or what positions you have. So you really need to have very different indicators. They are not commonly known. And you see like for trading, like you can leverage like so many times. And if you go to a bank to take a loan, right, they still need to like screen your credit rating and everything, like it's a very long process. However, trading, you can just like borrow, like you can leverage maybe like 500 times. Then maybe the next second you lose all money, right? So there's really a very key conflict of interest. So you need to sort of find different ways to see the market, because they already know what tools you are using, and then they can sort of, calculate your move in the market.
All right. Thank you. Our next question is from Anand, and he asked, how can technical analysis be useful in this current climate when it's based on market sentiments?
Okay, I will answer this question. So you're saying that the market sentiment will move the market, right? However, in technical trading, we follow trends, we have follow indicators. Therefore, the sentiment doesn't really affect us, because right, when there is sentiment, the trend will start to change. And since you are following the trend and we are looking at indicators, we can treat a shorter time frame. Therefore, I don't think this market sentiment will affect technical trading much. It basically affects a lot on the fundamental trading. Yeah.
Okay, thank you, Wang Po. Our next question from Deepak. He asks, are there other indicators viable when you trade Forex? Apart from the ones that you all mentioned.
Oh, definitely there is a lot of other indicators that you can use. For example, the MACD. For example, some people use the stochastic. Some people use Fibonacci level. There are definitely a lot of different ways. It really depends on your strategy. So basically, right, you cannot just use one indicator as a trading strategy. That is not a strategy. A strategy, you need to have different kind of conditions and make use of different kind of indicators, chart patterns, price actions to form a perfect setup for yourself. So it doesn't really come to one or two indicators. You need to find out different kind of indicators to help each other to make up what the other indicators cannot show. So your new indicator can show that part to give you a good entry and selling point. Yeah. So all the indicators are actually useful. It really depends on how you use it. For example, right, for moving average, some people use it to find trends. Some people use it as support resistance. So different people use it differently. As long as it works for you, then it will be a good indicator.
All right. Our next question from Jiawen. So she mentioned that she has done technical trading on and off for a year or so and would like to take trading as a full-time job. So how does she go about to start? So do you guys have any recommendations for her?
You want me to answer?
Yeah,
okay. So basically, right, you need to ask yourself whether you profit consistently from the market based on a single strategy, or sometimes you're lucky, you earn money, sometimes you lose money. It really depends. You need to have a strategy that can consistent and use the profit. And at the same time, you must know that the market always change. Sometimes your strategy works. Some works for like maybe for the year 2019, your strategy works and you earn consistent profit from it. But in 2020, the way the market moves change and your strategy start to lose money. Yeah. So if you want to become a full-time trader, basically I think you need to spend more time to learn to try out first. I don't think 1 year is enough for you to actually decide to become a full-time trader. Yeah.
All right. Thank you both Wang Po and Wei Cheng for your honest answers and opinions. So due to time constraints, that would mark our last question for the question and answer segment. So I would like to thank both Wei Cheng and Wang Po for this insightful session. I hope that everyone has developed a better understanding on the fundamentals of technical analysis. We thank you for making the time to attend this webinar and hope that it has been an informative session for you. We would appreciate it if you could leave some feedback for us so that we could better know the type of content you guys are looking for. So upon completion of the feedback, as seen from the slides above, you'll be granted access to today's slides, as well as stand a chance to win a Starbucks card in our lucky draw. We will be announcing the 2 winners of this lucky draw on our LinkedIn page, so do stay tuned. Also, do not forget to subscribe to our YouTube channel if you found this content useful. So once again, thank you all for your time and do join us for our upcoming sessions. Have a nice week ahead. Thank you.